Hello, everyone. Thank you very much for being a part of our AMA that we had a couple days ago about crypto taxes. And there were so many questions that people sent in advance and also during the chat session. We decided to put together a special show where we answered all those remaining questions because everybody's question is important and we wanted to make sure we got to it. I hope it's of value to you. With me today is Ben Weber, who is our director of crypto analytics. His team of people do gain calculation analytics, and they're world class. There's never been a customer that has been too complex for us to do. We've had customers with 5 million transactions, customers with 75 wallets and addresses, and customers have just done all crazy investments. Ben's team gets it done. So he's the right person here to answer a lot of those questions. Thank you very much. And as always, if you have a tax question that's a little bit beyond your ability to research, give us a call at CryptoTaxAudit.com. You can speak to me or Ben or one of my other directors about your particular situation in a confidential manner. Let's go ahead and get started.
How likely is it that the US government could come after compliant crypto wallets? In the past, they went after gold holders. What do you think about this one, Clinton?
Well, in fact, this has happened, but it's only because the IRS, the government, starts with an initially wrong assumption. We saw this a lot in 2020. A number of customers started to get audited on their 2018 reporting. And the reason being is because of the nature of the 1099s that Coinbase sent out. Coinbase would send out like a bottom line total value proceeds. I had one customer that Coinbase issued a 1099K at the time. It showed $4 million of proceeds, but he didn't report any of this on his tax return. He actually didn't report crypto at all. And when they audited him, when your team did the gain calculation, he ended up actually losing 17,000. And in fact, most people in 2018 lost their shirts because crypto went down between 50 and 90%. So the IRS had an initial wrong assumption. Now, the way to prevent this is to make sure that the IRS doesn't have an assumption that you have failed to report all your income. So how will that happen? Well, now, and the IRS really wants these 1099 DAs to avoid the kind of mistakes that I just referred to. So the 1099 DAs this year only reports proceeds, and next year it will also add cost basis if the exchange knows what it is. And what they want you to do is look at the total proceeds. That's the value of anything that went to fiat or got swapped for another crypto. The total value of those proceeds in US dollars needs to equal or exceed the amount that you report on your form 8949 for digital transactions. So if you do that, then the IRS, the government will not think that you've underreported it. They're only going to come after you if you fail to do that. The way they would come after you, we believe, is that if you have failed to report a 1099 DA, you'll get a letter. We call this a computer generated audit. We'll just send you a letter and they say, hey, you forgot to report this, and we're going to treat it all as income, and you owe us an amount of money, which is going to be astronomical just because there's no cost basis. And that's going to put you on a fast march to defend yourself. And at that point in time, it could become ugly. You simply don't want your face on an auditor's dartboard. So you want to make sure you file your tax return correctly. If you did a lot of trades, it might behoove you to have CryptoTaxAudit, our firm, do not just your gain calculation, but also file a tax return. We charge more than you're probably used to, but you're going to have peace of mind. We've done over 5,000 crypto tax returns. None of them have been audited under cryptocurrency reporting. So that's my 2 cents on that.
I totally agree. The first step is just filing your tax returns. Moving on to the next one. If I move crypto from a brokerage account like Robinhood to a cold wallet, could that be mistakenly treated as a redemption and included as proceeds on Form 1099 DA? So for the exchanges, they are not going to report transfers out of your account, and they will not treat those as proceeds. They will not report them as a trade, and they will not treat them as proceeds. These will be internal transfers from your brokerage to your wallet. Now, you are going to have to track the cost basis on that asset as it's being transferred from Robinhood, in this example, to your cold wallet.
I need help filing my crypto taxes. What's the best place to start? Well, to do your crypto taxes, you want to make sure you gather all the 1099 DAs that might be coming your way. Now, what's a 1099 DA? Well, you've probably heard of other 1099s. A DA is a brand new one. DA stands for digital assets, which is IRS terminology for cryptocurrencies. And every US based crypto exchange, and there's many of them, will be issuing these to you and to the IRS. So you want to make sure you receive those. You got Coinbase, Kraken, Uphold, Robinhood, they're the big ones, of course, but there's lots of small boutique services out there that also may have a reporting obligation. So you want to make sure you gather all those documents. These will probably be electronically downloaded, so you may have to go to those services to pull them down. That's the first place to start. Gather all those documents. Then you want to calculate the gain. Now, gain on cryptocurrency only occurs when you are selling for cash or fiat, or if you're exchanging one crypto for another crypto. And when you exchange one, you experience some sort of gain, which can be measured in the fair market value in US dollars. Another source of income would be if you had various types of rewards, staking rewards, airdrops, mining rewards. These also are forms of income. They're not capital gain income, but they are what's called other income and are reportable. You're also going to want to get the transaction histories for all your exchanges, whether they're US based or not. And if you're using DeFi, you're going to need to use those addresses to pull the transaction records off. There are a number of low priced services out there that can help you do that gain calculation, like Coin Ledger, Token Tax, Coin Tracker, Coinly. I think those are the big ones. These services can work, but you might find that your situation, you're not coming up with an answer that is close to what you think your actual profit is. And if that's the case, trust your instincts. I can just tell you that from years of experience. Trust your instincts. If the answer that these services are coming up with is too great, then you need to probably consult our company and get a full service gain calculation where we do the entire analytical work for you. There are immense number of mistakes and foibles that occur when people do it themselves, resulting in significantly higher amount of profit being reported and having to pay more taxes than necessary. And you're going to save so much in taxes. Most of the time, it pays for the cost of a full service gain. So if that's the case for you, then contact us. That's kind of how you do it. Once you've calculated the gain and the income, you're going to hand those over to your tax return preparer, or if you're doing it yourself, and report those in the appropriate places. It's going to be tricky this year with these 1099 DAs, but that's the place to start. More thorough answer than usual, but that's it. Next question.
All right. What if my crypto tax software can't accurately reflect my holdings because of missing or incorrect data from exchanges or wallets? This is all too common of a problem that crypto investors face when it comes tax time, especially if you're going back several years. The further back you have to go to reconcile your transactions, the harder it's going to be. The more challenging it's going to be to access all your records. So it's best to be proactive. Download your transaction histories throughout the year as you're trading. If the exchanges don't offer an option to download your transaction histories, make sure you're recording the transactions as you go along. Now, if you're in this situation where you don't have access to data, maybe you're kicked off a foreign exchange or you just no longer have access to an account, this is something that my team specializes in. We're really good at going through all your data, whether it's complete or not, and making sure we get to a reasonable and defensible gain calculation that we can report on the tax return and defend in an IRS audit. What type of crypto tax situations are you seeing most often with new clients right now? At the moment, we see a lot of clients using the Solana blockchain, trading meme coins, participating in liquidity pools. But to be honest, this past year, what I've noticed is a lot of people have calmed down their crypto investing from prior years. Going back to 2021, a lot of people were jumping into the DeFi space, going into anything that they could without realizing what the tax consequences would be later or the difficulties in trying to figure out the tax impact. I see a lot of people trying to simplify their crypto investing, reduce the number of wallets they have, the number of exchanges, and really just the overall number of transactions. I think a lot of people realize the burden of taxes and the challenge of reconciling all their transactions, and they've really just tried to simplify their situation. How should wrapped ETH staking tokens like EETH from Ether.finance be treated for tax purposes, given they function like IOUs with staking rewards? This is something I come across very often. I have two answers for these, and I look at each situation independently and judge it by how these wrap tokens are functioning. For example, when you wrap ETH, so ETH to wrapped ETH, WETH, wrapped ETH is essentially the same token as ETH. The function is the same, and the value is roughly the same, just maybe slightly different. Now, wrapped ETH is used to transfer to other blockchains like layer 2s to enable the use of Ethereum on those blockchains. It is also necessary to wrap ETH to interact with certain protocols on the Ethereum network. In fact, you can't do certain things without wrapping it. Even though it might not appear that you're wrapping it, under the hood, Ethereum is being wrapped. In this case, Ethereum to wrapped Ethereum, I would take the position that these are non-taxable transactions because wrapped Ethereum is essentially the same as Ethereum. You could, to be conservative, treat that as a taxable trade. Now, looking at other wrapped tokens like EETH, you have to look at what's going on in the background to decide and determine how to track it, as well as what makes sense from an accounting perspective. If EETH is just a receipt token for your Ethereum, then I would argue that this would be a non-taxable transaction. However, if EETH can also be traded for other tokens, if EETH has a different valuation than ETH, if it functions differently, then you might want to take the approach that these are taxable trades when you wrap them. You have to take into account intention. Is your intention to use EETH as a form of staking to earn rewards? Or is it to be able to use ETH as a form of liquid staking where you can easily trade it for other tokens? So there's a lot that you have to consider. That's just a high overview. If you're wrapping tokens for various purposes, get in touch with our team. We can come up with a strategy that makes sense for your situation. Not all situations are going to be the same on the blockchain. There's a lot that we look at to make a determination on how something should be treated for tax purposes. How do you correctly transfer crypto assets from a personal account to an S Corp?
I can answer that. Well, an S Corp is a legal entity, and there needs to be separation of your assets between your personal ones and the S Corp. Now, if you're moving of assets into the S Corp as part of the initial equity creation of the company, then that's one issue, but you're putting it into there and you're transferring the cost basis into the S Corporation. But it needs to be held on separate wallets. And when you trade, you need to trade, let's say you're going on to like Robinhood, you need to trade on accounts that are created with the KYC for the S Corp. You cannot intermingle the two. Intermingling the two will look like distributions, and you're going to create a real tax nightmare for yourself.
I'd also like to add that when I talk to clients who have partnerships with other people, businesses with other people, or S Corps, I generally recommend funding the company with cash. Do not fund it with crypto. Most people that fund it with crypto are not tracking it, and it becomes a nightmare later to figure out what the cost basis is that was transferred with the asset. If anything, take distributions or contribute using a stable coin. It's much easier to track. The cost basis is typically pegged to the dollar. But I would stay away from funding your companies with cryptocurrencies. Cash is way easier to account for.
How would you feel, Ben, if they used like a stable coin for that purpose?
Exactly. I think that that's fine. From a tracking perspective, It's not complicated. You typically take the assumption that the cost basis will be equal to the dollar. So if they transfer 100 USDC, the cost basis on those tokens will roughly be 100 USD. That makes tracking a lot easier. If you're doing other tokens, now you're going to have to create schedules and you're going to have workbooks showing all your cost basis. Like if you're transferring Bitcoin into the partnership or the S Corp, and that cost basis on the Bitcoin will transfer. So just a lot more to keep track of, and it's a lot easier to get for things to get messy. How to report miscellaneous bankruptcy losses. Get in touch with our team. There's a lot that goes into these. Not every situation is the same. We have to look at your situation in detail, see what was lost, what was recovered, if you had loans. There's a lot that goes into there. Likely you'll have some tax benefit, but do realize that the loss that you're going to report in the end is going to be your cost basis and the assets that are determined lost. So your initial investment in those assets. Now, like I said, every situation's special. Get in touch with our team. We'll be able to help walk you through these. We've unfortunately helped out probably 100 people who fell victim to the Celsius bankruptcy loss. Moving on. Are Bitcoin network fees considered a taxable event? And when calculating gains or losses, which price is used? The closing price for that day? Great question. So yes, network fees are taxable events. They are considered disposals, and there will be a gain or loss that you will need to calculate. The price that you'll use is the price at the time of the transaction. Um, Most tax softwares, crypto tax softwares, are pulling and pricing data. Typically, sometimes they have it, once an hour or every 30 minutes. So something that's reasonable will be fine. What is the best way to claim loss for worthless crypto that no longer trades?
How do you claim a loss for a worthless crypto? You have cryptos, there's been a rug pull, whatever. It's worthless, not going anywhere. You want to claim a loss. The IRS came out with regulations that said that, or advice that you had to actually dispose of that crypto. But how do you dispose of something that nobody wants? Well, there are what are called burn addresses. If you search for that, you'll find burn addresses. And basically transferring those cryptos to an address that nobody's using. And that effectively serves as a disposal. You're getting $0 for it. So you're basically selling that asset for $0, and then we can claim that on your tax return. But you actually have to do it. Just claiming it's worthless, the IRS feels that's not sufficient.
Setting up a crypto Roth IRA. And what should people be careful about? Well, I'm going to answer the second part of this first just because it sticks out to me so much. Do not intermingle your personal wallet with wallets or accounts in your Roth IRA. Any cryptos that are in your Roth IRA need to stay in the accounts or wallets associated with the Roth. Intermingling your assets between yourself and the Roth, that's going to create a tax nightmare. That could be an early distribution or non qualified contribution. There's just a lot that goes into these Roth IRAs and standard IRAs that people don't think about. My recommendation, always fund it with cash through the normal means that you would set up a Roth or a traditional IRA, and stay away from intermingling your assets.
Yeah, I'd add to what Ben's saying. When you want to have a crypto Roth, then what you have to do is set up a self-directed IRA, which may involve setting up an LLC. But then you have the issue of taking the assets in that Roth and buying cryptocurrency. And I had one client who said, I really wanted to do it, but Coinbase was taking months to approve the creation of an account, just my Roth IRA. So I just moved the money into my personal wallet and I bought that coin before the price went up. And I said, well, what you did was just create a distribution that's taxable. You're subject to a 10% penalty. So when self-directed IRAs are like walking around with hand grenades with the pin pulled, it's extremely easy to destroy yourself. I would suggest this: if you absolutely need to take money that's in a Roth or an IRA and invest it in crypto, I would suggest you use ETFs, because ETFs allow you to avoid the whole self-custody pitfall, and it's very clean and easy. You can get in and out without creating a lot of complications. It's easy to manage. So that'd be my advice on that. But and if you think about it, a lot about cryptocurrency is about having control of your own assets and not trusting on the government or the banks to hold your assets. But when you put something into a Roth IRA, you're basically tying all sorts of government and tax restrictions around those assets, which is kind of the reason people got away from cash and wanted to go to crypto in the first place. So you need to really think that through if that's what your intent is.
I 100% agree. Just go through your traditional brokerage, invest in ETFs, Bitcoin or Ethereum ETFs. That route will be much easier. You don't have to think. Your brokerage will handle all the tax forms for you. If you withdraw from a 401k in small amounts each year during retirement, does that actually lower your overall tax burden?
I'll answer. So one of the challenges with IRAs and 401ks, well, let me put it this way. The promise that they sell you about these IRAs and 401ks is that right now you're making a lot of money, you're at a higher tax bracket, and then when you're retired, you'll be in a lower tax bracket. When you take this money out, you won't be taxed as much. Well, let's just talk about what that means. Let's say you're in a higher tax bracket now. Let's say you're in a 32% bracket. And then when you are now on Social Security and pensions, let's say you drop down to a 22% tax bracket. You have a 10% savings on that tax. A lot of people make the mistake when they retire, they take out a big chunk of money from their IRAs or 401ks and they buy that dream car, dream house, vacation, whatever. And what happens is they're actually, by taking out a big amount, they actually pop up into a higher tax bracket. Maybe they bump back up to 32%, maybe higher. And they've lost all the promise and the benefit of it. Now, of course, there's also tax deferral on gains stuff, but it ultimately ripples through to the same. The smart thing is to take your money out in small amounts, the required minimum distributions. It keeps your tax burden from not rising up into a higher tax bracket. So that's the whole notion of that.
Is a Roth IRA truly better than a traditional 401k or IRA since there are required minimum distributions later in life?
I'll answer that. Well, we have a blog post or a YouTube video out about this, and I'll just tell you there is an entire industry created to confuse you on these sorts of things. The financial industry, the investment firms, banks, everybody wants you to tie up your money for long periods of time. And the government puts all these crazy rules, required minimum distributions, penalties for early withdrawal, certain age limits, all this stuff in the rules. Now, I will say this, that I am a contrarian in this area. And I personally think that all these rules about IRAs are what Michael Saylor would describe as the matrix. They're meant to distract you from really making true gains on your investments. Own your own assets. Don't allow them to be tied up with government rules so you don't have to ask questions like this and go around in circles, because when you ask questions like this, you're falling into the matrix. So nobody else is going to tell you that. So I just told you that. If you want to get the real answer to that, go talk to someone else who is a specialist in matrix math. Well, that's it for our questions that were submitted, and we're glad we could answer everybody's questions. Hopefully you had one and we answered it. I want to thank Ben Weber for giving us a lot of great insight and information. He's an incredible expert, and this is the type of talent that we bring to solving our clients' crypto tax and gain calculation needs. So go to CryptoTaxAudit.com, schedule a consultation. If you have a personal situation you'd like to discuss in a private, confidential manner, you can learn about our bulletproof tax returns, our fixed price gain calculations, which we can defend before the IRS. Thank you very much and have a great day.